welcome to my Ocean One and Then Some channel. This is video number 2 on trading options, and I'm just going to introduce you to the basic terms that you need to know to be able to do this. This would be a good starting point. So what are options? Options are weird little creatures that give you just what it sounds like. They give you options. You're not actually purchasing the shares, you're purchasing control. And when you purchase one option, terminology you need to know is contract. That's called a contract. So if you purchase one contract, you're technically controlling 100 shares. So let's just walk you through a basic example of purchasing a call. Now, the purpose of this video will eventually be to sell calls and sell puts, but let's start with the basics. So you purchase a call. I think this is what most traders are going to be familiar with. You purchase a call for, let's just say SoFi, and you purchase a $16 call. You're expecting SoFi to trade above $16 plus what you paid for the premium. And let's just say that's 50 cents. So you paid 50 cents multiplied by 100. Options always get multiplied by 100. So 0.50 times 100 is going to be $50. So you paid $50 for the right to purchase SoFi at $16 whenever that strike rolls around. So you need SoFi to be above $16.50 for you to score any type of victory there. So if you'll get your brain wrapped around calls and puts as insurance, you will understand it so much easier. So you purchased one call at the $16 strike, and you paid 50 cents for it, which gets multiplied by 100. So you paid $50 for it, and the strike is at $16. So you paid 50. So you paid 50 cents. I know it's strange. They always get multiplied by 100, but you have to do that for the math. So you paid $50 for it. And you need SoFi to trade above 1650. So if it trades at 1655, 17, 1750, you had a winning trade. If it trades at anything below 1650 and you hold till expiration, you had a losing trade. Why? Because you paid 50 cents for it, multiplied by 150. And you had the $16 strike. So what this should show you is, as a general rule, purchasing calls works in the favor of the seller, because when you purchased that call, you paid the seller 50 cents or $50 for that contract. That seller is hoping that SoFi trades below 1650. That's what they want. You're hoping it trades above 1650. That's what you want. So you have to account for the premium and you have to account for the strike price. So that's a call in very simple terms. Now a put is no different. It's just the opposite side of the coin. A put is insurance to sell at a certain strike price. So let's say you purchased a $16 put. Well, what you were thinking is, you were thinking that SoFi is going to go down in value, and you're thinking it's going to trade at $15.50 or $15 or $14.50 or 14 or 13, pick any number below 16, and then you still want to be able to sell your shares for $16. And you can do that because you purchased insurance. So the put is simply on the sell side, and the call is simply on the buy side as a buyer. So pretty simple stuff, actually. Now I'm going to continue to go over some terms before I get into actually setting up any type of trades. I think setting up any type of trades will be in the third video that I do, so you'll have a better understanding of it. So if you don't need the very basics here, if you don't need the terminology, then you could stop this video and you could simply go to the third video. But let's work through what I think are the most important terms that you need to know. Okay, the next thing that you need to know is the terminology. When you're selling a call, you sell to open. So when you go in to make your trade, you go to the options chain, You pick the option, and then you click sell to open. That's confusing because you've probably never done that before. And then if you want to close the trade at any time, you can close the trade at any time. Then you go to purchase to close. So it's sell to open, or purchase to close, or buy to close, whatever the terminology is there. So you're going to sell to open, and you're going to buy to close. That's how you get out of a trade. So if the trade is not going your way, you can simply buy to close and start a new trade. I do that all the time. I'll do that during the week. Sometimes I will wait until Fridays. It just depends. Usually if I'm up over 50% on the trade, usually as a percentage, I will close that trade out and I will open a new trade. Why do I do that? To lock in profits. About any time I'm over 80%, I will almost always close out the trade and start a new one. So my guideline is usually around 50%. Once I get above 50%, as I'm earning that, the trade is going my way, I'm up 50% or more, I will usually close out the trade, and I simply do that by buying to close. I close my own insurance. So when you sell to open, you're opening your own insurance. When you buy to close, you're closing your own insurance. So those are the two terms that you really need to know. Buy to open and, I'm sorry, I said that wrong. Sell to open and buy to close. Okay, there's two terms that you need to be familiar with. You don't need to be terribly familiar with these terms. You have what's called the Greeks and options, and I find some of them not very useful. It really just depends on how you're structuring your trades. The one that is probably the most useful for everyone is simply delta. Delta is useful in a couple different ways. It will tell you how much the option will go up or down based on every dollar that it differences in the trade. So if SoFi is at 16 and it goes down to 15, the delta will tell you how much it will go up or down in value. Another way to use delta is as a percentage for the winning trade. So when you look at delta, and let's say the delta is 55, okay? As a general rule, you can take that 55 and say, 55. That means that I have a 55% chance of this being in the money, meaning a winning trade. So you can also use it that way. Now, I don't use delta a whole lot myself. I'm more of a wing it person. I just set it up and usually don't check the delta. A lot of people do. I generally do not. The other one is theta. Theta is important in the sense that you're always selling time. You want time to work for you. So theta is the decay that the option will go up or down, typically down, of course, because you're selling time. Theta almost always goes down because each day that passes makes it look closer and closer to the way the trade is actually going to go. So when you take out a trade, let's say it's a week out or 2 weeks out or 3 weeks out, theta will start working in your favor. So as a seller, you're selling time and you're selling insurance. So you want theta to work for you, and as time marches on, the decay of that premium will generally work in your favor. So delta and theta are two big ones. If you want to do any more research on that, of course you can, and I would encourage you to if you're interested, but those are the two big words that you need to know, delta and theta. Now, the other thing that most beginning traders will find confusing is using the bid and the ask. When you go into the options chain and you set up your first trade, remember you're going to sell to open, and then if you want to close it, you're going to buy to close. But when you go in there, you're going to see a bid and you're going to see an ask. The bid is basically what a person is willing to pay. The ask is basically what a person is willing to sell for. So let's just pick a number, okay? Let's just keep it very simple. And the bid is 0.40, which would be $40. And the ask is 0.60, which would be $60. generally speaking, what's it going to take to get a trade to go through? Well, you pretty much have to meet in the middle as a general rule. So you're going to put in a limit order for 0.50 or slightly above if it will allow you. Usually options won't allow you to put in like 0.51 or 0.52. They might allow you to put in 0.55. Usually you have to go in nickels. So if it's 0.40 as a bid, 0.60 as an ask, generally you can put in 0.50, and if you're patient, it will generally go through depending on the direction that the stock is trading. So you will want to put in a limit order. Now, if you put in a market order, guess what's going to happen? Poof. You're going to, it's going to go through straight at the ask or the bid, depending on whether you are a seller or a buyer. So you want to set that up to pay as little or collect as much as possible. So just remember to always split the bid and the ask. And as you get used to that, let's just say you put it in and it sits there for 20 minutes. It's not going anywhere. Well, you just go in and edit it. Bump it up a nickel or bump it down a nickel, whatever it takes to get the trade to go through. So as we get more and more into this, remember, I'm going to focus on the selling side, not the buying side. But as a beginner's tutorial, of course, you have to hit both sides. So those are the terms that I think are very important, and hopefully this video will help you. The next video that I do will simply be walking you through a simple trade. Now, it's not going to be one that I actually am doing. It's simply walking you through how you would set up a trade.